Hello and welcome to Market Domination. I'm Josh Lipton alongside Shauna Smith, live from our NYC headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell on Wall Street.
I think the last reading and the one before it to in inflation, the one before it to a lesser extent, do suggest that we are getting back on a disinflationary path. We want to be more confident that inflation is moving sustainably down toward 2% before we start the process of reducing how tight our policy is, of loosening policy.
He's kind of like really voicing investor sentiment right now is we'll see what's going to happen because there's a lot of uncertainty, even though the market right now is reflecting strength.
There is still the risk of further price cuts ahead, and there is still further question on fundamentals. We are still facing somewhat of an EV winter on demand. So good results, but I think the fundamental macro backdrop is still the same.
I wouldn't necessarily be overly concerned that the labor market is heating back up as a result of these data. In fact, it makes some sense to me that we're stabilizing potentially after a few months of a sharp downturn.
All right, we've got 1 hour until the closing bell. Let's take a look at where things stand right now. And it has been a record-setting day here for the markets, at least at this point with an hour to go. You've got the Nasdaq, that huge number up there on your screen, 18,000, crossing above that level here for the first time, and flipping it over to the S&P 500, some of the trending that we have seen so far today. As we flip over to that intraday chart here, you can say it's still just below that 5,500 level, but still moving to the upside, on track to close at a new record high. When you take a look at the Dow, we're also looking at gains there, up just around 89 points as of right now. Taking a look at the bond market, there are lots of focus on that over the last 48 hours, but again, we're seeing a bit of cooling here as yields pull back after brushing up against that 4-5 level yesterday. Take a look at the sector action. Consumer discretionary outperforming here. Financials not too far behind, but you've got consumer discretionary by far the leader in today's trading action. On the flip side, you've got healthcare and energy as the underperformers. Well, that outperformance there from consumer discretionary, a lot of that is to do with the gains that we're seeing in Tesla alone today. You've got Tesla just off the highs of the session, but still moving to the upside, up about 9% today on the heels of better than expected delivery numbers. That's carrying the consumer discretionary sector there, the leader in today's trading action. You've also got much of the mega cap tech names in the green. You've got Apple, Amazon, both up just around 1.5%. Nvidia giving back some of its recent gains there, off just over 1% today, Josh.
All right, Shauna, new job openings unexpectedly rising in May, topping economists' expectations. The new data is showing a resilient labor market ahead of Friday's full jobs report. Joining us now is Matthew Lazzetti, Deutsche Bank chief U.S. economist. Matt, it is good to see you. And let's get right to your take, Matt. I'm interested what you think is coming on Friday morning with that big jobs report. It was interesting, Matt. I don't know if you saw Nick Timrose, his latest column at the Journal. It was a good one. And the way sort of Nick kind of framed it was interesting. As a question, he sort of asked, is the labor market in this sustained equilibrium where the unemployment rate kind of settles out around 4%, or no, we keep softening, resulting in recession? I'm interested, Matt, how you think about that question.
Yeah, I think anytime you have kind of a slowing in the economy that's taking place, there's always a question about the trajectory. Are we slowing to something that's more worrying, a stalling out in the economy or perhaps even a recession? Or is it going from a very robust growth environment that we had last year back down to just something that's far more normal? I think it's definitely the latter. I think if you look at this morning's JOLTS data, you mentioned job openings were higher. Actually, the hiring rate had picked up. The quits rate has stabilized at somewhat low levels over the past 6 months. But all that together does suggest that after softening over the past 6 months or so, you're seeing a labor market that is stabilizing at this point in time. For Friday, we expect that you see jobs added about 225,000. The unemployment rate remains steady at 4%, but actually risk that could round down to 3.9%. They see average hourly earnings or wage growth firm again at 0.4%. And I think if we get that data point, it will alleviate some of the concerns around the idea that the labor market could be cooling too much.
My question to you is, as we have seen some of these softer econ prints here as of late, discounting the JOLTS report out this morning, but we have seen weakness in housing, manufacturing also coming in a bit weaker than expected earlier this week. What does that tell us just about your confidence here? Are you still confident that we are going to see a soft landing and be able to avoid a recession?
Yeah, it's still our baseline. You're right. You are seeing some slowing in the data. A lot of this was anticipated for quite some time. On the manufacturing side, the ISM manufacturing index was a little bit softer than expected. But actually, if you look at new orders relative to inventories, it's showing that we should have good growth momentum in the manufacturing sector. And that's actually a similar signal that we got from the PMI data this week as well. I think there's going to be a lot of focus on the consumer as we look ahead. Obviously, there's a lot of interplay between the consumer and the labor market. But if we continue to see a labor market that churns out meaningful income growth, something that we actually saw in the personal income report last week, it's really hard for me to see a reason why, with very high wealth, meaningful income growth for consumers, why the consumer should slow in a worrying way.
And Matt, when we talk about the consumer, of course, there's different consumers, high income, middle income, low income. Do you have a read on kind of how each is doing right now and what you see ahead?
Yeah, no doubt. I think you have a lot of heterogeneity in the consumer experience at this point in time. That is being driven in part by the drawdown in excess savings that we've had, particularly at the bottom half of the income distribution. You're seeing certainly some strains or stresses showing up there with higher delinquency rates. On the other side, if you look at the upper half of the income distribution, higher income households, they're benefiting from very high house prices, from equities that are near record levels. The fact that they're locked into low mortgage rates kind of insulates them from higher interest rates at this point in time. And the labor market is still chugging along here, despite the slowing that we've seen. So there is definitely some divergences in the data that we're seeing. I think importantly, though, from an aggregate or macro perspective, which is what the Fed will be most focused on, at the moment, it looks like a consumer that's slowing just to more comfortable levels rather than something that is either stalling out or recessionary at this point.
So Matt, given that, and also just the commentary from Fed Chair Jay Powell earlier today, I'm curious just to get your perspective on what this tells us about that first rate cut, because he didn't explicitly say or give us any hints on the timing. But when you take into account what he is saying or what he did say, the fact that the labor market is cooling, the fact that he is very much encouraged by some of the progress that we have seen on inflation, what does that then tell us, just do you think, about the odds of a cut in September?
Yeah, our baseline is that you get one cut this year and that it happens in December. But there are certainly some prospects for a September rate cut. That can come in one of two ways: that we get better inflation data over the next several months. And as that clip showed, Chair Powell has been encouraged by at least the last inflation print. Certainly if we get something that looks like last Friday's core PC print over the next several months, the Fed could very well cut at the September meeting. The other way to get to a rate cut is that you have a weakening in the labor market that's unexpected. That's the area where that is a downside risk, but it is not part of our baseline at the moment. From Chair Powell's comments this morning, I did sense a little bit of a dovish tone to that. He was encouraged by the inflation data. He's certainly looking at a labor market that is coming into much better balance and is not an important source of inflation at this point in time. And so really they'll be data dependent. Essentially, if they get very good inflation data over the next few months, that will certainly improve the prospects for a September rate cut.
Matt, election is front and center. That means tariffs are front and center as well. Biden and Trump have both embraced that. I'm just interested, as an economist, how you think, Matt, about that policy tool. Do you think it's smart? Do you think it's effective? What's the potential impact on the economy, Matt?
Yeah, I think from an impact on the economy perspective, it really matters kind of the breadth and size of those tariffs. Certainly we've seen President Biden embrace that to a certain extent, but it's been quite narrow on things like imports of electric vehicles from China. The proposed tariffs from the potential Trump administration are much broader. They're much higher. He's thinking and contemplating a 10% universal baseline tariff. That's a 10% tariff across the board, contemplating 50 to 60% tariffs on imports from China. That would have a meaningful macro impact. And so, as we think about the Federal Reserve in particular over the next year, December and then into next year, the election outcome will be important for how much they cut rates. And if we get an election outcome that promises fiscal stimulus via tax cuts and inflationary policies through tariffs, it'll be less likely that the Fed cuts rates meaningfully next year.
Matt, great to have you on today. Thanks for helping us kick off the show. Appreciate it.
Thanks for having me.
We are just getting started here on market domination, and coming up, Tesla shares getting a lift after the EV makers surprised the street with better than expected deliveries in Q2. More on what that means for the company's road ahead next. Plus, we'll discuss some of the top trending tickers on Yahoo Finance.
Gearing up for the 4th of July vacation, travel plans could prove bumpy with a record number of Americans expected to hit the road. We've got the outlook ahead. Tesla shares jumping as the EV giant reports upbeat results for deliveries. Wall Street pleasantly surprised with a lower than expected decline of nearly 5% in deliveries compared to just a year ago. Joining us now to discuss, we want to bring in Barron's associate editor, Al Root. Al, it's good to see you. So let's talk about these numbers that we're just getting out here from Tesla, because coming in better than expected. When you take a look at the market's reaction, clearly they were very excited about the print that was published this morning. So what does that tell us just about where Tesla stands? Is the worst over for Tesla?
Yeah, I think that if you look at the reaction today, the message is sort of the worst is over. Several notes from Wall Street basically indicate that. And, you know, one of the interesting questions I got early in the day was, well, how did they do it? I mean, it was a very good quarter, better than the first quarter, where they delivered about 387,000. But like that graphic shows, it's still down year over year. So part of how they did it is basically just meeting lowered expectations or beating lowered expectations. Estimates always tend to fall headed into the print. That certainly happened this time as well. So it was a good quarter. Again, I just think there was so much anxiety over, 2 consecutive year-over-year declines. How bad is it going to be? Is it going to be 420,000 units? It wasn't that bad.
Al, next date on the calendar for Tesla investors, July 23rd, earnings day. What are you expecting to hear there, Al? Are there certain metrics you're going to make a beeline for in that print?
The deliveries are connected to that, right? They also did 9.4 gigawatt hours of storage. That goes in their other business category. That was a record for a quarter by, more than 100%. So that's more revenue. And then with the deliveries being a little better than expected, I will go right to that operating profit margin. Right, they did about 5.5% operating profit margins in the first quarter, down from about 11% a year ago. Margins have been steadily marching lower as they've lowered prices and growth has slowed. So I would like to see that turn around. The street's expecting about 8%, so the street expects some improvement. So we'll look at operating margins, and we will look for the reversal in earnings estimate declines. This delivery result is good enough where earnings estimates shouldn't have to be cut into the quarter, and you can expect sort of, the standard beat, and look forward to the rest of the year, Q1, Q2 being the worst part of the year, and then establishing this idea that Tesla can grow again in the back half and then in 2025.
Yeah, so Al, with that in mind, I guess my question is on pricing then. Do you think the pricing wars that have played out, that Tesla has had to lower its prices on vehicles really across the world, that maybe that isn't going to be as big of a driving factor here when we talk about some of the pressure that has put on margins?
Well, interestingly, to your point, Tesla produced far fewer vehicles than it sold, so Tesla's inventories are lower. So that lowers the pressure for them to cut their prices further to clear out some of that inventory. But they're only one, right? They're about 50% of the U.S. They're about 20% globally of all electric vehicle sales. So, other people have to play along. EV growth in China has been better, but again, that's partially been boosted by pricing. I think the safe thing to say is pricing is probably going to bump along the bottom. So it's not necessarily going to be the pressure it was in 2023 and early in 2024. Some of the delivery results, not only from Tesla, but Rivian, NIO, XPeng, Li, BYD, indicate that vehicles are being sold at these levels. So, the car companies might say to themselves, okay, we're good. We can just sort of operate at these levels. But again, it's not totally up to Tesla. At least from their perspective, there's less pressure to keep cutting prices.
And Al, I want to switch gears a bit, talk about another company you know very well. That's Boeing. You just made a visit, Al, to a Boeing manufacturing plant. Walk us through it. What did you learn?
So Boeing usually does investor events, right, or media events, and they bring everybody out there. We were in the Renton facility that builds 737 MAX. So obviously that's a very big deal this year. Emergency door plug blew out on Jan 5th. The stock was about $249 a share then. You see it on the graphic there. It's below 186. Most of that's related to 737 quality issues. So they spent basically time trying to explain how quality was improving. Now, a plane facility, it is sort of an awesome site, right? It's huge, it's clean. There's a lot of people doing a lot of things. There's more than 2 million parts. If you add up all the rivets and everything, there's more than 2 million parts in a 737. So it would be foolish to say that, I went to the plant and now I know that quality's improved. But they spent a lot of time trying to carefully detail, these are the kinds of changes we've made. So something like that can never happen again. And so, we can ramp production and put this in the rearview mirror. Time will heal all wounds in the case of Boeing. They don't really have a lot of leeway. They have to be perfect from this point forward. And I left the plant saying, okay, at least, there are things being done in terms of training, measuring employee efficiency, slowing the work down. They've delivered a lot fewer 737 MAXs than even their customers would like. But that's all part of the process of digging themselves out of this hole they built.
I'm curious, what was the feeling like from employees there or those associated with Boeing? And then when you talk about how obviously it's going to take time here for manufacturing to improve, any sense of just more so what exactly that timeline looks like?
So it's a years-long process, years-long, right? So, if we're talking about Tesla, deliver 444,000 cars. Boeing and Airbus combined will deliver like 1,100 planes this year. They take, there's a lot fewer of them. They're a lot more money. They're huge. So, where Tesla, looking to turn things around in a quarter or two, Boeing, in terms of production quality, should be looking to turn it around in a year or two. And people might want to see that process sped up, but that's just sort of the reality of plane manufacturing. So it'll take a while. And, the things that investors can look for is, they're basically delivering 20 a month. They're allowed to deliver 38 a month. So getting back to 38 and then having the FAA say, you know what, you can make 50 a month, which is their long-term goal or one of their long-term goals. I mean, and then also seeing some of these other derivatives of the 737 MAX approved, like the 737 MAX 7 or the longer version called the Dash 10. These things will come out, between now and 2026, and then people will basically say, "Oh, okay, things are getting better at Boeing." From an employee perspective, each individual employee, very proud of their work, can talk about all of their training. Most interestingly, through COVID, at some of the suppliers, Boeing couldn't really quantify or didn't want to quantify it. 20% turnover at some of these places, so there is a huge curve that some of these people have to go up to get proficient. And I think that really caught Boeing short over the last couple of years as they've run into some of these problems.
Al, if we're talking Boeing, we also got to talk about who's going to lead this company. Calhoun stepping down. There's been that chatter, Al, about Spirit Aerosystems, Pat Shanahan. What do you make of that?
Okay, so we looked at this a little while ago, and the names that always came up were Pat Shanahan from Spirit, Larry Culp from General Electric, Stephanie Pope, who's the COO, who's the internal candidate, maybe somebody wild like Gwen Shotwell from SpaceX. Larry is firmly ensconced at GE. Pat is a legitimate candidate to replace Dave Calhoun. And there's just an endless debate over, should you go internal? Should they have no ties to Boeing? Should they have a lot of ties to Boeing because it's a complex organization where you need a lot of credibility internally? There is just no good answer. I could show you CEOs that came from outside Boeing that did well. Dave Muhlenberg, the guy who lost his job to Dave Calhoun because of the 737 MAX crisis in 2018, 2019. He was an internal candidate and an engineer. Steve Mollenkopf, the old CEO of Qualcomm, is running this process to find the next guy. I would say it's probably been harder than he thought, right? We haven't seen basically any development in months. And it is going to be tough to handicap. Like, to answer your question directly, Shanahan is one of the leaders. I would say Stephanie Pope, internal candidate, is one of the leaders in the clubhouse, and we'll just have to see how it develops.
All right, we'll bring you back when we have the news. Al, thank you so much for being on the show today. Always love having you.
Yep, see you guys.
Time to check in on some of today's top trending tickers. Eli Lilly receiving FDA approval for its Alzheimer drug, Kisunla. Yahoo Finance's Anjali Kamlani has been following that story and joins us now with more, Anj.
That's right. Good news for Eli Lilly, like you mentioned, finally getting that approval. We expected it after the advisory committee meeting last month, in which it was unanimously recommended for approval. This is great for Alzheimer's patients. Now the second drug on the market for patients. Just a reminder, Eli Lilly's drug was found to have a reduced cognitive decline by 35% over 18 months. It's a monthly infusion, so they do have to go to a clinical care center to receive this. Best for those aged 60 to 85 years with mild dementia, and it is basically delivered until the plaque, the buildup in the brain, that's what it targets, clears up. The price tag attached to that, $32,000 for the year. That's a little bit higher than the now competitor Biogen and Eisai's Leqembi, which has been on the market for $26,500 per year. That is delivered more frequently through infusion. So Eli Lilly did mention, of course, that the prices will vary by individual. So that is just sort of a top line price, if you will.
All right, on. So Eli Lilly there, when you take a look at shares pairing some of their earlier losses, have been under pressure. Them along with Novo Nordisk on the heels of this op-ed that we got from President Biden and also from Senator Sanders, targeting the cost of GLP-1 drugs. What can you tell us there? And just in terms of how big of a maybe an overhang this could potentially be if we do continue to see this type of pressure.
Yeah, that op-ed was really interesting because it definitely had a lot of Senator Bernie Sanders talking points, right? He's been harping on Novo Nordisk in particular and kind of letting the Lilly hang back, even though both do have pretty high prices for both their GLP-1s. Those are, for a refresher, Eli Lilly's are Mounjaro and Zepbound. Mounjaro for diabetes, Zepbound for weight loss, as well as Novo Nordisk Ozempic for diabetes and Wegovy for weight loss, as you can see on your screen, at or over, near or over $1,000 per month. That's the monthly prescription cost. And those are the list prices. And so that's sort of where we get into the dirty details. Now, this has been part of Senator Sanders for some time. He's been focusing on them. So he did say in the op-ed that, these companies, basically, if they don't reduce those prices, the government will be forced to then reduce it for them. And then Lilly and Novo Nordisk both gave statements to Yahoo Finance. In a statement, Eli Lilly said that basically comparing list prices in the United States to other countries is basically doing an injustice. It's too complex. And that's the equivalent of what Novo Nordisk also said, that they're disappointed. That's a very difficult and complex problem that's being oversimplified for political purposes. Very strong comments there. And this all on the heels of the Treat and Reduce Obesity Act that just got its first ray of sunshine, got passed out of the House Ways and Means Committee, which means that Medicare will finally get a chance to actually evaluate, or rather the Congressional Budget Office will finally get a chance to evaluate the cost to Medicare for these drugs. So that bill did get reduced to kind of a limited population, but we're looking at really a shift in the focus of these drugs and the potential for government impact as well.
Stories that we'll continue to watch, right, Anj? Great stuff, thanks. Let's take a look at Archer Aviation. The stock moving sky high today on news that Stellantis is investing $55 million more into the EV tollmaker. Now, last month, Archer CEO Adam Goldstein spoke to Yahoo Finance about increasing investor interest.
It's not just Archer that's out there building that. We've seen really investment come from all over the place globally, as this has the potential to be a really large industry and really help, be transformative in the way that people are traveling.
So the excitement that we're seeing today and this investment that we're seeing from Stellantis coming on the back of a successful transition flight here for Archer. It's being hailed as a milestone here for the company. So again, the stock down pretty significantly since the start of the year, but we are seeing some optimism play out on the street.
All right, a little
today.
more enthusiasm. Moving on, Nikola shares higher today after the EV makers saying it wholesaled 72 Class 8 Nikola hydrogen fuel cell trucks in the second quarter, and that, Shauna, was above the 60-unit high end of expectations, 112 during the first half. Reports of new customers, too, like Walmart Canada.
Yeah, I think there's lots of questions just about what exactly the future still looks like for Nikola. We are certainly seeing this excitement play out in the market today. But again, when you take a look even at those numbers, yes, it is coming in better than expectations, but they're still not delivering a significant number of these, or getting assignments here for a significant number of these trucks. 72 Class 8 Nikola hydrogen fuel cell trucks here, 2 wholesalers during the quarter. So again, even when you take a look at that chart year to date, you're looking at a stock that's off 69%.
Yeah, it's a nice pop today, but it has been hammered.
It has been hammered for quite some time.
And coming up, shares of Paramount. That's you, Sean. I jumped right in. I was so excited. I jumped in. I couldn't help myself.
Because we're talking about Paramount, it seems like every single day at this point. So let's update you with what is new today. We just had this crossing earlier this afternoon. Paramount rising today on the back of a report that it is selling its BET network for $1.6 billion. That's according to Bloomberg. Now, Paramount is in exclusive talks to sell the Black Entertainment Television Network to buyers that include its CEO, Scott Mills, and also another individual who runs the New York-based private equity firm CC Capital. So again, they have been rumored to have interest here going back to last year. Now we have that $1.6 billion. It looks like the offer that could be on the table here. So we, of course, will see how all this plays out, because they are far from the only people who have been interested in BET Network over the last.
Didn't we see those other reports too? Barry Diller, maybe kicking the tire, National Amusements, What does Sherry Redstone want? That's the question, Shauna. What is it?
And it doesn't seem like
Is it just the money?
Well,
is that what it is?
I don't know. And it also seems like so many of these offers that have been put forward here over the last several months. Obviously, we talk about Skydance when we talk about Paramount overall here, and how those talks kind of fell apart most recently. But even with BET, when you go back to last year, the same group had discussed an offer of just under $2 billion. You also go back to some others who have been interested in the company. Byron Allen have been interested in it, Tyler Perry, and their offers have not been good enough for Redstone. So to answer your question, I have no idea.
Well, maybe Sherry comes on the show.
We'll see.
Talks us through it.
Always welcome.
Moving on, stocks rallying higher today as investors react to fresh commentary from Federal Reserve Chair Jerome Powell, who cheered the disinflationary path of recent economic data. Powell said Tuesday that he is encouraged by cooler inflation, but reinforced that the central bank will need to see more evidence before cutting interest rates. For more on the path ahead for the Fed, let's now welcome in George Ball, Sanders Morris Harris Chairman. George, it is good to see you. So, talking about the environment, George, this was an interesting note in which we find ourselves in. You say, George, it's not Goldilocks, but Winnie the Pooh would be very happy in today's environment. I will confess, George, I do have a 5-year-old at home, but I am not that up to speed on Winnie the Pooh. Walk us through what you mean there, George. What is the Winnie Pooh environment?
Winnie the Pooh and his friend Christopher Robin would walk through the forest very happily, hand in hand. And that's really what's happening in the economy and in the marketplaces today. Chairman Powell is happy. Inflation is headed in the right direction, but it's not there yet. American business is showing that it can make very healthy profits and have near record profit margins, even with interest rates at what I would call 5%. So Christopher Robin and Winnie the Pooh are walking through the forest happily. Powell is pleased with the trajectory of inflation, and business is very pleased with its ability to earn good and growing profits in a higher interest rate climate than many people thought. It's not Goldilocks, but it's a damn good backdrop for both business and the economy right now.
Well, what happens next, though, George? I mean, how long can this continue? And if it can continue, then what does that recessionary risk look like?
There are always going to be recessions. If people think that either the Fed or any other exogenous body can create a backdrop that gives us either Goldilocks or Winnie the Pooh from now until the end of time, it's not going to happen. We do have a growth period that's a long in the tooth one. And simply by the evolution of the stop clock is right twice every 24 hours, we are headed toward, I think, a period of time where we're going to get something like a recession or a recession-esque that is going to dampen profits and probably hurt the stock market at the same time. But again, that's not because of policy failures. It's simply that economies and growth and innovation get tired after a while. And I think late in 2024 and 2025, we're going to see that a slowing in profits and a dip in the stock market ahead of us, not because of the Fed or fiscal policy, but even despite it.
And George, your message to investors here, one message. You say stay where you are in your portfolio if your stock holdings are in your normal range. Would you say, George, you want to stay where you are, you want to stay in those positions? Or, George, I mean, after the run we've had here in the first half, I mean, do you want to take some of those winnings, put that money to work in some new names?
The most boring thing in the world, it's not popular either as media or in any other way, is to say, stay where you are. But yeah, we all know that trying to time the market is a fool's game. People who try to time the market end up poor. Second, there is nothing in the economic outlook that means somebody should try to take chips off the table. You want to be a participant in the growth of America that takes place over time. You don't want to say, gosh, I made a lot of money, I'm going to pull out and be on the sidelines. It's not that, that's not something that's smart in almost any period. So I hate to be boring and say, stay the course, but stay the course, even if it is boring.
George, what do you think of the action, though, that we've seen in the bond market? Because we did see Chair Powell's comments on disinflation put some downward pressure on yields today. And then you compare that to the massive run-up that we saw in yields over the last 2 trading days. Has that build-up in yields at least run its course for now? Or if we do brush up, once again, up against that 4.5 level, what does that then look like for equities?
Chairman Powell wants inflation to be dead. And then he wants to do an MRI to make sure that it's dead and to show the MRI to everybody so that the world at large understands that it's dead. We are probably going to see a period of time when the Fed suppresses short-term rates, but where in the fairly near future, there are fears that a Trump administration or a second Biden administration will be fiscally profligate, and that will put upward pressure on yields in the longer term part of the market. So I think we'll see 450 and above before we see 425 and below on the 10-year Treasury bond, using that as a good bellwether.
George, we covered the markets, the Fed, Winnie the Pooh. We covered a lot of ground, George. Thanks for coming on the show today. Appreciate it.
Thanks, Josh.
Coming up, we are checking in on the biggest names in chips. Stay tuned. More market domination on the other side.
Nvidia shares pulling back today. The AI market darling falling further from that record high that it reached not too long ago. Our next guest, though, isn't worried about the bumpy path that we have seen for Nvidia over the last several weeks. He's got a buy rating on the stock, the highest price target on the street. We want to bring in Hans Mosesmann. He is Rosenblatt Securities, a senior research analyst. It's great to have you here. So when you take a look at what has been certainly a volatile couple of weeks for Nvidia, some of that sell side pressure on the stock, why isn't that worrisome to you?
Well, we're entering new territory for Nvidia. The valuation really out of thin air almost over the past year. The move has been such that it has people kind of worried, like, how's that even possible? And it requires you to have an understanding of what's going on with AI and their leadership position. So it could be a little bumpy, but from a secular perspective, for the next 10 years, this is going to be the way to play AI. They're at another level. And I think people have to just get used to that. And they're not a semiconductor company anymore. They're a platform. They're all things AI.
And Hans, I'm assuming if you're bullish on Nvidia too, Hans, you must be also then bullish on just the bigger mega trend of AI that you must think, yes, it is this paradigm shift. And yes, Jensen Huang is right when he talks about, how the next industrial revolution has begun, Hans.
Yeah, that's right. So there are a couple of moving parts. And so the cloud, which is where most of Nvidia's business is not going to be the home of all things AI. As time goes on, more AI gets done, not up there in the cloud, but in the mid-edge, the far edge. And it opens up the door for more efficient solutions in terms of platform, hardware, and even software. So there are other players that will benefit from that transition, such as AMD, such as ARM, a little company called Lattice that we cover. So there's other participants, but in terms of the value capture of AI, Nvidia may lose unit market share, but they may actually gain value because they're monetizing the entire stack. That's the entire rack, the entire software that goes around that. So it's a formidable model that I think people have yet to kind of fully grasp.
Hans, what you just said a minute ago there, that Nvidia is no longer just a chip maker, it's all things AI. That has actually captured the attention of regulators around the world. And earlier this week, we got the Reuters report out that actually France is looking Nvidia is setting potentially facing some antitrust charges there in France. I'm curious to you just how you're assessing that risk from an analyst perspective and to what extent this could ultimately be a headwind here for the stock.
Yeah, I think that NVIDIA competitors and NVIDIA observers and countries get worried about a company that is grasping or capturing all of this value. So there is a knee-jerk reaction in some cases to stop that. They've already endured the U.S. basically with these restrictions on China. 25% of the business is basically gone, and they're still basically sold out. So it's something to watch. But they are not being predatory in the least, even though prices have been moving up. It's not the price of the chip or the board or the rack that is driving this business. It's the value created by the total cost of ownership. It's a different metric that we in the semiconductor industry are not used to, right? You can double the price of this product and it provides significant TCO, performance per watt, per cubic foot, per dollar advantages that nobody can meet, right? It's not like there's another guy that can do it. Maybe AMD captures some share here, but it's a little different. But yes, it's something to monitor. In France is something that kind of raises eyebrows and so on. But at the moment, I don't think it's going to lead to anything because they're being fair in terms of how they price their products, in my opinion.
Hans, as you know, Jensen is building out this platform. As he expands, Hans, he moves into new areas, new verticals. Are there companies that you think should be worried?
Well, so the traditional way of doing things in silicon are changing. So that the let's call it the general purpose server market is being really destroyed in terms of value by moving to an accelerated cycle. So, guys like Intel and even AMD, if AMD didn't have a GPU, for example, they'd be in big trouble. So they are changing the way compute is done. And so the next wave of value capture for NVIDIA, if you look at, say, the cloud, for example, are networking areas, storage areas, And so you start to kind of bring in those areas in terms of value, and you maximize the interface between networking and storage with the computer, the accelerated compute. So I think that the traditional networking players and storage players probably have to deal with this. There are ways to get around that. For example, Broadcom and Marvell, which are big players in networking, they have the ability to do custom chips. And so some of the hyperscalers don't want to use NVIDIA all the time. They want to do their own custom, highly efficient, very expensive accelerators. And so there's another kind of theme that is counter to that. But it is interesting how, if you look at NVIDIA's roadmap, how they expect to capture not just the GPU, the compute, but the entire rack and everything that goes inside a rack and a data center.
Hans, there's been more and more talk about some of the competitors within this space. Even when you take a look at Micron, that has certainly gotten a lot of attention here. I'm curious just what you think of that comparison. And then more specifically, some of that price action that we've seen on Micron since its earnings report. What is the street missing that you see given your bullish thesis there?
So my top two picks for this year are the ones that have kind of underperformed here a bit of late, AMD and Micron. So Micron is an enabler. They're not a competitor to NVIDIA. So Micron provides very useful and fundamental memory, be it DDR5, which is more commoditized, or this new high bandwidth memory, which the industry is currently constrained, probably sold out for the next year, maybe year and a half. So NVIDIA needs Micron and Samsung and Hynix to bolster their production, get their yields right. AMD is more of a competitor and coming from nowhere. And AMD is being helped by hyperscalers and Broadcom and some of the networking guys. As you can see, an emerging battle of the titans where a lot of the industry, hyperscalers, chip companies, which feel threatened by NVIDIA, are kind of teaming up to do battle with what I would call, like a Godzilla-like personality here with NVIDIA, the green monster, if you will. So that's kind of how things are playing out. It'll be a battle that will last a long, long time, but I think NVIDIA has the advantage here. Over time, you can think of this as, an Apple with the iPhone and that ecosystem doing battle with Android. They kind of coexist, but that's how I think it could play out.
Hans, great having you on the show today. Thanks for making time for us.
You got it.
Now let's get to some calls of the day here. Piper Sandler downgrading CrowdStrike from overweight to neutral, citing the stock's risk reward after a strong run. And to be clear, this is Piper's Rob Owens, who's been covering this space a long time, covering cybersecurity names for a long time. When Rob speaks, I listen, Sandra. That's what I'm trying to say, okay? And he basically says this is a valuation call. Tells his clients, listen, he looks at the valuation relative to the software companies he covers, north of $75 billion in market cap. Current valuation, he says, places CrowdStrike with the highest 2025 multiple on sales and among the highest on free cash flow. In other words, he thinks it looks pricey. Yeah, exactly. And I think that's everyone's takeaway from this call. And you can see, you listen and the street listens too, because you can see that in the pressure that we are seeing on shares today, off just about 1.5%. But remember, this is a stock that had been up more than 50% year to date. It's rallied just 10% since the announcement of its inclusion within the S&P. So clearly there has been a lot of excitement, a lot of that driven by some of those underlying factors, fundamental factors that Rob Owens does remain very bullish on still going forward. But again, saying that current valuation levels, it might be due for just a bit of a break here. But going forward, he's saying that he's taking an intermission prior to the second act, to put it in his words, but he still believes that strong fundamental performance is going to continue here and sees a number of catalysts ahead. Well, coming up, taking a look at how to play small cap names in your portfolio next on Market Domination.
Small caps, simply put, are struggling to keep up with the broader market. While the S&P 500 has notched numerous record highs since the year began, the Russell 2000 has gained less than 0.5%. We're looking at how to navigate small caps in your portfolio with the Yahoo Finance Playbook. Joined now by Paul Bayaki. He's SS&C Alps Advisors, a chief ETF strategist. It's great to have you here, Paul. So walk us through exactly why maybe now investors should be rotating just a bit and be a bit more bullish on small caps given the underperformance that we've seen now for some time.
Well, I think you touched on it in your lead-in where basically the S&P 500 continues to climb and make new all-time highs, and yet the Russell 2000 small and mid caps really haven't done anything to participate in that rally. And you go back 5 or 6 years and you've basically had sideways action in small caps. And if you look at the ratio between the Russell 2000 and the S&P 500, so just divide one by the other, and we're at the lowest levels we've seen in more than 20 years. You have to go back to the end of the dot-com era to see any time when small caps, at least at a price level, have looked like this relative to large caps. Then you look at valuations and you look at the PE spread between large caps and small caps as defined by the Russell 2000 and S&P 500. And historically speaking, when you get that type of anomalous relative valuation, it does portend to potentially strong relative performance on a go-forward basis. But as always, anytime there is a valuation story in the market, you have to think about what it means short-term and long-term. Valuation is not necessarily a signal for near-term outperformance, but there's reasons why small caps are relatively cheap compared to their large cap counterparts.
What about, Paul, earnings growth for the small caps? Just broadly, what do you expect versus large caps?
Well, I think the earnings growth picture for small caps is significantly muted compared to large caps, although I will say that a lot of the large cap growth, at least in earnings, in aggregate, is dragged up by the significant growth we're getting from the top of the cap spectrum. So growth expectations for the Russell 2000 in a mid cap universe is much more subdued than for a large cap universe. And as we talked about, there are warts in this universe. You do have a valuation story in place, but you have 9% of the Russell 2000 in regional banks. That's a segment of the market that faces significant economic headwinds. You have 40% of the Russell 2000 famously that doesn't make money. So forget about earnings growth. Just think about profitability in and of itself. And then you have 50% or so of that index, which has floating rate debt. So when thinking about allocating to small and mid caps, I think of a lot of allocators and a lot of advisors are trying to balance what they see as an economic cycle that might be favorable to small caps. They typically perform well when you get to the end of a Fed rate hiking cycle, but also that valuation story.
So, Paul, I guess my question to you is, where are you seeing those opportunities, given when you take a look at the Russell 2000, there's a heck of a lot of companies in there. When you take a look at those balance sheets, they look very different in terms of profitable, those that are profitable and those that are not. So how are you, I guess, determining those winners? And then when we talk about catalysts, how much of this call is contingent upon the Fed cutting in terms of what that catalyst is going to be when we talk about a bit of this shift in rotation?
Well, I think there's very simple ways to reconfigure a small and mid-cap oriented strategy to avoid some of the worst outcomes. So something that OUSM, the ETF Alps offers, does is it screens for companies with high ROA, so profitability, low leverage, so low net debt to EBITDA, companies that pay dividends, have grown their dividends, and have strong dividend coverage. So you cull that universe down to, let's say, 100, 115 names that are defined by the quality characteristics that an active manager might look for when picking and choosing in that market. And when you look historically at the risk-reward profile of a quality-oriented small and mid-cap portfolio, it may not give you full leverage to a rip-your-face-off rally in small and mid-cap stocks, but ideally what it does through its low volatility screens as well as those quality screens is avoid some of the worst companies in that universe and therefore some of the worst drawdowns in that universe. But in terms of catalysts, one of the things that historically has been positive for small caps is when you get this type of wide valuation gap between small and large cap companies, which we currently see, but also if the Fed does indeed start to cut rates 1 time, 2 times, or more into the back half of 2024 or into 2025, that should ease some of the tension economically on some of those beleaguered small cap companies. Because I mentioned 9% of the Russell 2000 is in regional banks. Well, why have regional banks suffered so much over the course of the past year and a half? Largely because of a mismatch between deposits, a mismatch between capital flight, and importantly, a mismatch between what they've lent money at and what they're borrowing money at in terms of rates.
All right, Paul Bayaki, we have to leave it there. Thanks so much for taking the time to join us today.
Thanks for having me.
We've got the closing bell on the other side of the break. Stay tuned. You're watching Market Domination. And that's the closing bell on Wall Street. And now it's market domination overtime. And take a look at where things are settled here today. It's a record-setting day, actually, for the street. We're going to check in with Jared Blickery there in just a minute. But take a look at that number on the screen right now, 5,500, crossing above that level, closing at a record high. And that's not all. You've also got the Nasdaq above 18,000 here for the first time. Taking a look at the Dow, not a new record here, but again, closing up just around 162 points. And taking a look at that intraday chart here today, you can see those gains escalating here over the last 2 hours of the trading session here to close up by just about 0.4%. Let's kick it over to Jared Blickery for a closer look at what was driving today's action, Jared.
Well, thank you, Shauna. You know, Nasdaq 18,000. I remember when Dow 20,000 seemed like forever away, and well, Nasdaq is right there on its doorstep. But let's take a look at the sector action first, and we'll circle back here maybe to the Nasdaq 100. Consumer discretionary was the #1 sector, and guess who's in that? Amazon and Tesla. Tesla having its best day in a number of weeks there, up 10% as it cracks the $200 level. But back to our sector action, financials also closing above 1%. And then to the downside, healthcare down about 1/3%, energy in the red, but not seeing a lot of big movement to the downside there. And looking at some of our leaders, we have, guess what, New York FANG, we know who that is, FANG plus SOX, that's a chip stocks, plus regional banks, plus IPOs, then disruptive tech, then Chinese stocks. That's a pretty varied group of stocks at the very top there. To the downside, Bitcoin was the biggest loser, down about 2%, followed by cannabis and biotech. But back to the Nasdaq 100, just want to show you real quickly, so not a record high for Nvidia there. That's the standout red rectangle there, but let's take a look at Tesla real quick. We'll be doing a deep dive on that later with Josh here, but look at real quick, just briefly, we dipped above the inverse head and shoulders here, and it looks like we're off to the races. Got a measured move up to somewhere in the 200s. Deal with that in about 30 minutes. And then I just want to take a look at Chinese stocks because those have been under a lot of pressure, but not today. We see Alibaba up 2%, JD.com up 1%, and for the most part, a pretty green day over there.
All right, Jared, thank you. It is not just the U.S. Inflation forces are at play in markets across the globe. European Central Bank President Christine Lagarde noting today at a panel in Sintra, Portugal, that she expects a bumpy road ahead for inflation across the Eurozone through the end of the year. And beyond inflation, several emerging market economies are grappling with consequential elections, geopolitical uncertainty, and FX headwinds in recent months. Joining us now, Alejo Chervanko, CIO, Emerging Markets Americas at UBS. Alejo, thanks for joining us on set. Appreciate it.
Thank you for having me.
I thought we would start with, investors, they hear emerging markets. You've been actually studying those markets for a long time, more than 10 years. How have they changed, Alejo? How are they different than, say, 5 years ago, 10 years ago?
I would start by highlighting that emerging markets are not your grandpas. Emerging markets.
What do you mean by that, Alejo?
They matured quite a bit, right? There's been an evolution of the asset class. Let me give you an example. 30 years ago, the emerging world was 3% investment grade. Today, we're talking about over 50% investment grade. 30 years ago, the typical emerging market was challenged by very, very high levels of inflation, fiscal irresponsibility, monetary policy dependence on the executive power. All that has changed. Inflation has come under control. We've got inflation targeting regimes and independent central banks. So this is a different asset class. When it comes to investment returns, they've been pretty good when it comes to bonds, fixed income. They haven't been as good when compared to the United States when it comes to equities. There are many reasons for that. But I think it's important to recognize that when you look at the health of balance sheets in emerging markets, they're superior today at the sovereign level, at the country level, than many developed markets. And even when it comes to different companies, you have very professionally run, healthy balance sheet companies out there in the emerging markets.
So now, Alejo, who's best positioned at this point, just in terms of growth that we could see, given we have seen obviously an improving picture, but when you square that with the opportunity versus some of the risk that's associated with high inflation, obviously not just a problem here for developed markets, but also for some of the emerging markets as well, and then also the political uncertainty side of things as well.
Yes, I would say political uncertainty has grown just about everywhere, right? You could even go as far as to conclude that there's more visibility in many emerging market elections today than there are in elections in a country like the United States, right? So I think it's a global phenomenon. Concretely to your question on the opportunity, if you're talking about bonds, you find attractive fixed income opportunities across regions. Latin America is an area ripe for these opportunities. You find relatively high yields that are not fully justified by the relatively solid fundamentals, right? When it comes to equities, maybe that's the land of Asia Pacific. India is a secular area of growth that we favor. Technology in the emerging markets is dominated by Asian markets. Consider the largest chip maker in the world, based out of Taiwan, the largest memory chip producer in the world, based out of South Korea. So Taiwan and Korea are some of the markets that we favor in the middle of the artificial intelligence revolution.
Leo, you mentioned the election here as well. I mean, obviously front and center. What are some possible ramifications or impacts our election could have on the emerging markets?
Absolutely. When you consider the vastly different views of how the U.S. should interact with the rest of the world, Trump vis-a-vis Biden, you can help to conclude that there are going to be consequences, right? The Biden administration in a 2.0 version would be a globalist, working with allies to achieve geopolitical goals. A Trump administration would be more focused on own tools, looking inwards, right? And this will have an impact on the U.S. relationship vis-a-vis Mexico, China, Ukraine. These are some of the main exponents, right? In addition, of course, to the Middle East. Some winners, some losers, but overall, there's simply every country in the world out there is looking at this race very, very closely because it will impact their own economies and their own political relationship with the largest economy in the world.
Two regions that you just mentioned before, India and China, and I bring that up just given the divergence that we're seeing in the performance of equities there. Yes. Is this a trend that you think can run for some time, and what are the implications of that?
We think so. Now, these are very, very different markets when it comes to the equity world. India is attractive from its secular growth perspective, demographics, reforms, geopolitical swing state status. Now, you're paying hefty prices for it, right? India, market-wise, is trading at over almost 24 times price earnings ratio, which is, expensive vis-a-vis own history, vis-a-vis other markets. So there's a lot of good news priced in. We think the market can continue to perform thanks to earnings growth dynamics. We're penciling in 15% earnings growth this year, next year. So this is mostly a carry play based on earnings growth. China, on the other hand, is trading much cheaper. There's a lot of bad news in Chinese equity valuation. So you could get, in some scenarios, a sharp re-rating of Chinese equities. And in some other scenarios, depending on geopolitical situations, domestic politics, domestic economic dynamics, a de-rating. So you've got a broader range, I think, of outcomes when it comes to China.
All right, Alejo, always great to have you. Thanks so much for joining us here on Set
Thank you
today.
so
We
much.
appreciate the time. All right, well, Amazon closing today at a new record high. As we go to break, take a look back at the history of the e-commerce giant in our latest edition of Beyond the Ticker.
From its start as an online bookstore to its rise in e-commerce and cloud computing, Amazon has become one of the world's most iconic brands. In 2023, the tech juggernaut generated over $575 billion in revenue and boasted more than 200 million Amazon Prime members worldwide. Beyond the Ticker takes a deep dive into some of the company's biggest moments. Amazon was founded in 1994 by Jeff Bezos in his garage in Bellevue, Washington. The company was originally conceived as an online bookstore designed to compete with Barnes & Noble. On May 15, 1997, Amazon went public via IPO at $18 per share. 1 year later, the company began selling CDs, marking the start of its effort to become a shopping Goliath. In 2005, Amazon launched Amazon Prime, a $79 per year membership with free 2-day shipping on eligible orders. A year later, Amazon launched Amazon Web Services. The platform would go on to become the top cloud computing service ahead of those from rivals Microsoft and Google, and one of Amazon's most successful businesses. In 2011, Amazon rebranded its video service as Amazon Instant Video, with access to 5,000 movies and TV shows for Prime members. 3 years later, Amazon acquired the video game streaming website Twitch for $970 million. Amazon then acquired high-end supermarket chain Whole Foods in 2017 for $13.7 billion. It has since integrated the two companies, offering discounts for Prime members. On September 4, 2018, Amazon became just the second U.S. company ever to reach a $1 trillion market cap after Apple reached it earlier in the year. Amazon sales and profits surged during the COVID-19 pandemic in 2020 as consumers turned to online shopping. In 2021, Bezos announced that he would step down from his role as CEO and be succeeded by AWS CEO Andy Jassy. In 2024, Amazon was added to the Dow Jones Industrial Average, replacing drugstore giant Walgreens. The company continues to evolve, investing billions in AI startup Anthropic, developing more smart home products, and launching an AI shopping assistant named Rufus. It's safe to say Amazon is a staple of the digital age.
Democratic voters are growing skeptical of President Biden's chances of getting reelected. That's according to a new CNN poll. But now one Democratic lawmaker is vocalizing his concerns. Democratic Congressman Lloyd Doggett of Texas calling for President Biden to withdraw from the presidential race earlier today. Here to discuss, we have Yahoo Finance's Rick Newman. And Rick, I think the question a lot of people are asking right now, whether or not Congressman Doggett is really the first of what is going to be others who are putting some more pressure on the Biden administration.
You're right. That's a big question right now. And when you mention that CNN poll, finding that the percentage of voters who think Biden should simply withdraw is going up, and it's pretty high. They're probably going to be more polls like that too, because the debate happened, 5 days ago now, and it just takes time to conduct polls so that people know, you're getting people who know what happened, and you can incorporate the latest events. And we should never make too much out of any single development, but I think what's happening in Biden world right now is concerns are rising that the dam might be about to break. And you would know the dam is breaking, I think, if you start to see more elected Democrats like Congressman Doggett coming out and saying, yes, they think Biden should withdraw, and especially if you would ever see the name brand Democrats in Washington, Chuck Schumer in the House, Hakeem Jeffries, anybody from Obama's group of people starting to say it's time for Biden to go, then that would suggest the pressure's really getting heavy on Biden and his insiders. And, just to add one other little data point here, the New York Times this afternoon just put out a story with more details than we've heard before about instances when Biden's advisors noticed that he was foggy, losing his train of thought and things like that. And this does not say, this doesn't say Biden is senile. It basically says he's probably pretty normal for an 81-year-old guy. He might even be more healthy than average, except that he's 81 and he has an extraordinarily demanding schedule by being president. So the Times is saying, yes, Biden does absolutely show moments when he's very sharp and he's assertive with other world leaders, but that even his own inner circle is starting to worry about times when he's slipping. So there's a lot of moving parts right now, and this is pretty dynamic.
Rick, last time we spoke, you put, I think it was 20% odds, Rick, that Biden would actually step down. You still at 20%, lower, higher? Where are you, Rick?
I guess I'm going higher, Josh. Maybe between 30 and 40%. I take my cues from a lot of seasoned political analysts who are pointing out that the Biden campaign was hoping that this pressure on Biden would blow over after the terrible debate he had last Thursday, and it is not blowing over. And one thing that will really be influential is if these polls start to show, and this CNN poll that Shauna mentioned at the top does show, that the numbers are worsening for Biden. So he's actually losing ground in the polls because of his terrible debate performance last week. We're going to see a lot more polls the next few days, and that is the main thing I think everybody's going to be looking for is there a significant worsening for Biden? And that will tell Biden's inner circle, as along with all the rest of us, this is not blowing over. It might actually be getting quite a lot worse.
Rick, always great to have your insight and perspective. Thanks for hopping on.
Bye, guys.
Joe Lonsdale co-founded Palantir and is the managing partner at 8VC, a venture capital firm. He recently wrote in The Economist about why he is backing Donald Trump, noting the only candidate in this race whose administration is likely to restore confidence to government is Mr. Trump. Joe joins us now to talk more about why he is supporting Trump in this presidential election. Joe, it is always great to have you on the show. In that piece of The Economist, Joe, you lay out different reasons you're backing Trump. But, Yahoo Finance, Joe, we've got a lot of traders, investors, business people listening. So I want to focus on that, Joe. Why do you think Trump is the better option for the American economy, Joe, and the American business community?
Thanks, Josh. I guess I'm a lot more focused myself on policies and rule of law than I am on the personalities. I respect people with different views on this. We live in a pluralistic country. We all work with people with different views. But, on my side, I'm sick and tired of this incompetence in government, right? We spend $7 billion, get a handful of chargers. We have $42 billion at the FCC for broadband. They can't get anything done. Of course, they could easily connect all these things with SpaceX, but they cancel the contract they're going to do with Starlink because they don't like Elon, right? It's a political thing. And then meanwhile, they start suing Elon with the DOJ for not hiring enough non-residents when the DoD tells them not to. And you just see this like again and again and again, like the CHIPS Act, for example. I think it's actually, I'm not a big fan of industrial policy, but I think it makes a lot of sense in a lot of ways for our country. It's a bipartisan act, and they push the CHIPS Act ahead. And there's like 19 DEI things in it. We're literally not building plants right now, Josh, because we can't find enough female construction workers. I mean, this is a joke. It's like there's like children in charge of the country. We need basic common sense back.
And why do you think, Joe, a Trump administration, rectifies that, changes course, cleans it up?
I mean, you just have to be direct about what actually works in the world and not afraid to offend people by doing what's right. Like the Trump administration is not going to have plants not being built because there's not enough female construction workers. Like, listen, I think our government in general is not a competent thing. And I think the people who are going to be around Trump, whether it's Vivek Ramaswamy, whether it's my other friends who are close to him from the tech world who are getting more involved, they're going to be cutting back on this waste. They're going to be just calling things as they are, and that's true for domestic policy. It's true for strength around the world. One of the things I just shared on X today, I saw, when Trump was talking to the Taliban and was planning to do things there, he says, if you give like me one bit of trouble, here's a picture of your house, you know not to do it. I don't think Biden is cogent enough or bold enough to interact with things in those common sense ways. I think he's just very, very careful. He's too politically correct. He's never run anything in his life. So I think this administration is full of people who are more focused on virtue signaling and not focused on actually getting things done. They're more focused on buying votes with student debt relief than actually doing things that are rational and logical for the economy.
Talking about rational, logical, Joe, one economic policy we know Trump believes in, tariffs, and he continues to hammer the table on that. In your opinion, Joe, as someone who's supporting Trump here, tariffs, smart, effective policy tool in your opinion?
Overall, Josh, I join most economists in being a fan of free trade. Free trade's created a lot of wealth in the world. There are probably certain areas where we've had free trade where it's great for us on Wall Street and not as great for certain communities that are competing against the rest of the world. And so, I think protecting certain things domestically is a populist right policy that's very popular. It's not necessarily where I'm coming from, but I understand where he's coming from. It's not crazy, and it is potentially the right thing to do sometimes to protect some of these communities.
Let me ask you, Joe, as a Trump supporter now, any thoughts on who you would like to see as his VP? Any thoughts there, Joe? Vance, Ruby, Huckabee, Sanders?
I'm friends with like 4 or 5 of these people, and I think they're all really competent. I think Vance is awesome. I don't think it's going to be Vivek, but I think he's a really important figure for.
Why do you say, Joe? Why do you say Vance is awesome? What do you like about Vance?
He's someone he worked for Peter Thiel when I was working for him before. He's smart. He's thoughtful. He's bold. I loved his book. He comes from a background where he really understands the struggles of a lot of people in America who come from the working class, who come from that background. Yet he also understands the innovation world, and having been in the innovation world, like that's what America is the best in the world at. That's the thing that like no one else can compete with us in. If we didn't have the innovation world, we'd probably look a lot more like Europe. We'd be a lot poorer. We'd be a lot more broken. Like being able to harness the innovation world while also being able to care about like the least well off. I think that's an awesome combination.
Joe, so you're back in Trump. What if though in November it doesn't work out that way as you hope for, Biden wins? As a venture investor, Joe, would that change where you want to invest, what you want to invest in?
I think overall, the fortunately defense has been a relatively nonpartisan area of our economy. Obviously, I think you have a little bit more peace through strength and kind of stronger defense stuff on the right. But unfortunately, I don't think that goes totally away either. America is going to be strong, I think, either way. So I think that part's strong. I think generally the value of our investments, the value of like being able to disrupt things in the economy aggressively with AI and create wealth, that's all going to work better with more free market policy, with less law from the regulators, with less of the administrative state randomly harassing people. The sad thing is, as a venture investor, if Biden wins, we'll probably have to spend a lot more time and money hiring people to go to DC to argue our cases for things. It's going to be a lot more crony-looking world as we're improving these industries. We'll probably look a lot more like China, a lot slower to disrupt and fix things. So I'm really hoping we have a more free economy instead.
Joe, you're not based in Texas, but you're a Bay Area native. You got deep roots in Silicon Valley. I'm curious to get your take about a trend, or what's talked about as a trend. In May, the New York Times publishes a story, Joe. The headline: some of Silicon Valley's most prominent investors are turning against Biden. They talked about some big names, Mark Andreessen, Chamath Palihapitiya. Of course, David Sachs is now supporting Trump. I'm just curious, though, Joe, in Silicon Valley, are you really seeing that? Is that an actual trend or just a few big, bold-faced names?
It's a big trend, Josh. I'm on a chat with about 150 people who are Silicon Valley investors and leaders, and these people are fed up. The FTC is doing crazy things that are not legal to block deals. One of my deals I sold, OpenGov, for $1.8 billion. One of the companies I started this year, one of the biggest deals in the last couple of years, thanks to Lena Khan blocking the bigger ones. I should thank her. I'm on the record board only because of her blocking bigger stuff. The SEC harassing people, meeting with Sam Bankman-Fried, but not meeting with other crypto CEOs who didn't donate to the left, right? This goes down the list. There's just like lawfare and corruption and waste and idiocy
and Joe,
coming out of the state. And when Obama was president, like I was in the White House sometimes talking with them, like all these guys in the White House, they wanted to hear from the tech world. They wanted to hear from you, even if you disagree. That I'm not saying Obama was someone I always agreed with, but at least there was competent people just talking with us. This administration has no idea what they're doing, and they're not interested in talking and hearing from the competent people in the innovation world, and that's a disaster.
And Joe, those people you're talking with on those chats, are they more comfortable now saying they support Trump than maybe they would have been a few years ago?
A lot of them are comfortable saying they're against Biden, and a lot of them are comfortable saying to us how frustrated they are with him. I think it takes a little extra bit of courage to come out and write that you're actually supporting Trump because of it, because obviously we have two flawed people and you have no perfect choice here. And I think they're still very scared to come out in public about it. But as a leader, that's my job to set the tone and to put out what other people are afraid to say.
Joe, great to have you on the show as always. Thanks for making time for us.
Thanks, Josh.
Time now for What to Watch. Wednesday, July 3rd, starting off on the Fed. Minutes from the June's FOMC meeting are due out in the afternoon. Ahead of that, we're going to be getting some Fed commentary from New York Fed President John Williams. It's coming after today's comments from Fed Chair Jerome Powell expressing satisfaction with inflation progress, but saying he still wants to see more before cutting rates.
Moving over to the economy, the latest ADP employment data for June is coming out in the morning. Economists forecasting that number to rise to 165,000, giving us more labor market insight ahead of Friday's full jobs report.
And on the earnings front, Constellation Brands is reporting before the open. The beer, wine, and spirits producer is announcing first quarter results. Analysts expecting the report to highlight the durability of its beer business, driven by volume, growth, and higher prices.
And finally, markets are closing early tomorrow ahead of the July 4th holiday. Our coverage tomorrow will begin at 11:30 a.m. Eastern Time with market domination. The markets will be closed on Thursday, July 4th. Well, that'll do it for us for today's Market Domination Overtime. Now, in light of tomorrow's holiday shortened trading day, we will be bringing you Market Domination starting at 11:30 a.m. Eastern Time tomorrow.
But don't go anywhere. On the other side of the break, it's asking for a trend. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. Here's some of the trends we're going to be diving into. EV makers Tesla and Rivian surprising Wall Street today with better than expected delivery numbers for Q2, but overall electric vehicle demand is not out of the woods just yet. High prices and charging anxiety still keeping many on the sidelines. Plus, planes, trains, and automobiles, airports, and interstates are gearing up for a record week of 4th of July travel. We're going to discuss what complications from extreme weather and higher gas prices mean for travelers. And the sluggish housing market is taking a toll. Home builder names getting hit with several downgrades today as analysts express concerns that the slow activity could last the year, but homeowners staying put could prove a tailwind for renovators. Hurricane Beryl barreling across the Caribbean, now passing south of the Dominican Republic. And the Category 5 hurricane is expected to bring life-threatening winds and storm surge to Jamaica tomorrow. Beryl is the earliest Category 5 storm ever to form in the Atlantic, fueled by record warm waters. And joining me now is Pauline Twidell, AAA Senior Vice President of Travel. So, Paul, what kind of travel effects have we seen so far? Can you walk us through what you're seeing?
Sure. Well, first, let's talk about the numbers. We're right in the midst of, 71 million people traveling for this Independence Day holiday from Saturday the 29th right through to July 7th. So tomorrow is going to be the busiest day. If we look in totality, that 71 million really is reflective of mostly road travel. People are going to be on the roads, 60.6. So nearly 61 million will be on the roads. And that's a record-breaking number for a totality and for road travel. Also flying, air travel, nearly 6 million, 5.7 are going to be traveling by air. That's 12% higher than pre-pandemic. So we've got a lot of people traveling. And the last thing we really need is weather getting in the way.
And that's 71 million, Paul. So you're saying record, you're saying that's higher than last year, that's even higher than pre-pandemic?
Yes, absolutely. It's 5% higher than 2023 and 8% over pre-pandemic, over 2019. So these are really staggering numbers.
What do you attribute that to, Paula? What are the variables, the factors?
Yeah, great question. We talk about pent-up demand and people think that that's over, but it's really not. Even despite inflation and all the numbers we talk about, consumers are not willing to give up the respite that they deserve. Consumer confidence still remains quite high, and people still spending money on this very discretionary income, but they're spending money to get away and enjoy themselves and getting out of the daily grind.
So, Paula, 71 million, huge number, record. Where are they going, Paula? Do we have any line of sight? Where are the destinations?
Yeah, absolutely. Domestically, first of all, like places like Seattle and Anchorage and certainly Canadian Vancouver, those all attribute to Alaska business because this is Alaska season now for cruises. So Pacific Northwest is very busy. And of course, we have domestic areas like the theme parks, Orlando being a top destination, as well as Anaheim and out in LA. And then, urban cities like New York, Denver, Chicago, people are traveling to those destinations too. Let's not forget about international travel because international travel is equally high. London, Paris, pre-Olympics. We have all this going on right now. People are really flocking to Europe, Dublin, Athens, Barcelona, all very, very strong destinations that we're seeing that people are flocking to right now.
Any advice you can offer viewers, Paula, about traditionally at least, when is the best and worst times to travel?
Yes, absolutely. And today being, tomorrow's the 3rd. So tomorrow is the busiest time to be on the road or in the air. We're going to find a lot of bottlenecks there. We can anticipate that, 30, 40, even up to 60% in some locations, traffic delays, because keep in mind, some people are on vacation traveling. Other people are still, working and have that rush hour traffic. So you want to stay away from those peak times. Your best time to travel is very early in the morning. Stay away from that 2 through 7 time frame, or go later in the evening after 7 or 8 o'clock at night. So best to go in the morning and avoid the rush hour if you can.
All right, great advice, Paula. Thanks for joining the show with that insight and guidance. We appreciate it.
Thank you.
The S&P 500 and Nasdaq closing at fresh record highs. Investors digesting fresh inflation commentary from Fed Chair Powell. Here with more on the trading day takeaways Yahoo Finance's Jared Blickery. Jared.
Josh, we got to talk about Tesla today. Huge breakout above the psychological level of $200. And I'm going to outline the technicals here. It's a number of milestones and breakthroughs depending on how you look at it. This is not what I'm looking for. We're going to go to our mega caps, and here we have Tesla closing in at $737 billion. So still not in the $1 trillion club. But here we have today's price action. Let me show you a 1 year with some candlesticks. And this is going to help outline the pattern I'm noting here. So this would be an inverse head and shoulders here. And you can see we've clearly broken out to the upside. You can also draw a trend line all the way down here. And guess what? We also broke above that trend line. So no matter how you slice it in these two different ways, probably going to get some momentum to the upside.
Resistance, support, what am I looking at?
Yeah, to the upside, we really don't have much resistance until about 265. So let me put a 2-year chart, see if I can find 265. It's going to be about somewhere in here. To the downside, 140 is a big level, but I think 150 would probably stop it. That was kind of the lower neckline of the head and shoulders. So all in all, I think we got some space to move to the upside. We got some space to move to the downside if it's a false breakout, but probably not going to stay right there.
We got earnings coming up. We got the big robo-taxi day in August, Jared. A lot for Tesla investors.
Yeah, a lot for and consumer discretionary. Let's not forget that Amazon and Tesla are actually in consumer discretionary.
There you go.
So point number 2, market concentration
Love this
tops
thing.
19.
It's right up there with seasonality.
Oh, 1929. You know, that was the peak of the stock market back in the day. And I got 2 different time series, 2 different lines. One of them goes all the way back to the 1920s. That's the purple. And one of them's blue. This has to do with market concentration. Really difficult to do these calculations, especially with these old series. But back in 1921, guess what the biggest stock in the universe was?
Give it to me.
AT&T, Ma Bell. So Ma Bell was such a big part of the market that it was all the way out here. And so this purple line is tracking the largest one stock relative to the 75th percentile, 3/4 of the way down. And then we also have this different measure that starts about, 1960 something, 1970, weight of the top 10 stocks. And you can see we are currently at about 33%. That is the highest level in this series. But for all the talk of concentration, is it different this time? Well, by both of these metrics, yes. This is the greatest concentration we've ever seen.
Let me ask you, we talk about concentration a lot in the SPX. Beyond the broad gauge, any other signs of concentration?
You know, I think it spills over into everything else because when you have just a few stocks like the mega caps that have been working so well, you tend to forget about the other ones and forget about the Russell 2000. What I think is interesting about this chart, this all goes back to the beginning of the Russell in 1979, measures small caps. So you take the Russell 2000 and divide it by the S&P 500, you can get the relative outperformance or underperformance. So here in the 1970s, early 80s, we were seeing outperformance of small caps. Here we are seeing the opposite. This is the outperformance of those mega caps, the underperformance of small caps. So this just tells me again, we've never quite seen anything like this concentration in the market, so it deserves to be handled a little bit delicately here. I will say this, I don't think it's an absolute disaster. We're seeing market rotation right now. We saw 3 months of outperformance by the big guys, so I think we're starting to see some backing and filling here.
Interesting. Third, Jared Blickery point. Here we go.
Stock volatility. Yeah, so I'm going to dial up, guess what? The VIX, which closed right around 10 or 12, excuse me. It dipped down pretty low today. And I'll put a 3-month chart with some candlesticks so we can see. And here we are. This is hard to see all the way down here, but this is not quite as low as some of the levels we were getting a month ago. But if I put a 10-year chart on, you can see this is really in the lower part of the range, especially when you consider where we are coming from in the pandemic. But we are not quite back down to those levels. I want to contrast this with what's happening in the ICE B of A move index. Now, this is bond market volatility. So where the VIX was all the way down here, well, guess what? This is trending up a little bit. A lot of times what we've seen over the last few years, bond market volatility spikes first, and then you get it leaking into equities market volatility. So while the VIX is low now, maybe this is a leading indicator.
Yeah, so my question, what would you expect to happen next? What's the read-through for investors?
I think it gets back to timing. We didn't do any seasonality. Let's do some seasonality here.
We're here.
We're looking at the VIX. Let me show you some VIX seasonality, because what we can expect now is, here's the VIX map. This purple line goes it is basically the average of what's happened since 1990 through 2023. The blue line is what's happened so far this year, and we're right during this period. This period right here is supposed to be pretty quiet. Guess what? July is supposed to be a bullish month, especially those first 10 days. I think we get those. But then we start seeing some hiccups here. When the VIX spikes up, that's when we start seeing stocks roll over. And then by the time we get to September, October, that's going to be those critical 2 months before the election. Guess what? That's when the VIX starts spiking historically. See no reason why it couldn't happen, but we'll have to see if it does.
All right, Jared, all the trading takeaways. Thank you, my friend. Perfect. Coming up, a pulse check on the renovation-minded homeowner with the co-founder of Angie's next on Asking for a Trend.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs.
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Home listings just keep rising, but much of the dismay of would-be home buyers, property prices are as well. It seems nothing, not even some of the highest mortgage rates of the past 2 decades, can stop the continued climb of home prices. Joining us now to help figure out what homeowners are thinking and where they're putting their money is Angie, co-founder Angie Hicks. Angie, it is good to see you. So you look at this housing market, Angie. I don't doubt the demand is there, but 30-year fix, Angie, we're here at 7.13%. For a lot of people, I just think affordability is an issue. Has that meant, Angie, we just see this trend of people who are thinking, you know what, I can't afford to buy that new home. Instead, I'll put my time, my effort, my money into upgrading and renovating the home I have?
You're definitely going to see people that would have normally thought about moving consider renovation. I mean, if they're thinking about taking and trading a mortgage that was at 3.5% or 4% and trading it for 7%, that is real money. That could be $12,000 a year increased expense on that mortgage. To give you a comparable, you could renovate your bathroom on average for about $12,000. And that can make a huge improvement in the livability of your house. So you really need to analyze why you want to move and make sure you're moving for the right reasons.
And Angie, when people do decide to renovate, do we have a sense of what they traditionally are looking to renovate? Is it bathrooms? Is it kitchens? And what are the smart rooms to innovate, just in terms of a return on investment?
Right. When we look at our state of home spending, bathrooms are always in the top 5 most common projects people tackle. It's a highly used room. Kitchens are always in the top 10, a little more pricey, but it is the heart of the home, and it's a place where you spend a lot of time with your family. So an important spot to renovate. And both of those are things that you do not want to do necessarily right when you're ready to move. You want to make sure you're going to live in your house for a while to make sure you get that return on investment. But if you're making that decision, should I move or should I renovate? Those are good items to consider.
What about outdoor remodeling, Angie? Remodeling the deck, still popular?
That became really popular during the pandemic, and we're seeing that continue to hang over. In fact, when people look at their 5-year plans for big renovation projects, the top 3 are bathrooms, kitchens, and large outdoor renovations. So thinking about that outdoor kitchen, a new patio, new landscaping, those are all really good investments into your home.
Do you expect, Angie, just looking out, you think about home renovation, home upgrades. Do you see that big trend continuing to be strong in the years ahead?
Well, it's interesting. So we saw a big pop during the pandemic, and I think a lot of people thought that spend on your home would start to decrease as we got back out and were traveling and doing a lot more things. But what we've seen is it stayed at this elevated level. And I expect it'll continue. In fact, 30% of the people in our most recent State of Home Spending report commented that they plan to do increased spending on renovation instead of moving because of interest rates.
Angie, let's say you're a viewer. You listen to us right now. You've been kind of thinking about doing a big home upgrade, a big home renovation. Give us some guidance, Angie. What are just some basic tips and tricks people need to think about?
Well, you really want to think about how you're using your home and what can be the biggest return for you and your family and how you live in it. You want your house to be livable and comfortable for you. So think about things and be clear about how much you want to spend. I think a lot of times we think about, I'd like to remodel my kitchen. Oh, that means I'm going to spend $30,000 or more. Not necessarily. So think about what the important things are in that renovation that you're going to do. An easy one, don't change the footprint of your kitchen, don't change where the plumbing is and the electrical, etc., and you're going to save a lot of money down the road. If you can refurbish the cabinets you have versus putting in new ones, another big expense saver. So it's really prioritizing what elements are important to you and laying your budget against it.
Angie, a last question for you. You took this idea and you turned it into a business, and I'm sure it was not easy. For any entrepreneurs who are listening right now, Angie, any guidance you would offer?
I think it's when you're starting a business, it's a lot about perseverance. You have an idea, you've got to stick with it, and you need to make sure that you're realizing exactly what you're good at and what you need to build in your team. I think having a really good team around you that can balance and add to what you offer is important. And sometimes that can be hard when you're first starting out. So making those initial hires is really important.
All right, great tips and tricks, Angie. Thanks so much for joining us today. Appreciate it.
Thank you.
And coming up, more asking for a trend on the other side.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs.
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
A new chart from Wells Fargo showing the potential rebalancing of earnings growth in the S&P 500. Yahoo Finance's Shauna Smith joins me now with a closer look. Shauna.
Yeah, Josh, when you take a look at this, so a lot of the focus on Wall Street is going to be shifting to earnings here when we kick off second quarter earnings season next week. And I want to bring up the growth expectations that we got from Wells Fargo today, because I think it's significant. A lot of times when we're talking to strategists day in and day out, our question is whether or not the narrow concentration within the market, how big of risk maybe that poses to the broader market at this point. And what we're seeing here in terms of those expectations from Wells Fargo is that we are going to see more of a broadening in terms of that earnings growth. It's not only going to be technology and communication services, which it very much has been, driving the earnings growth, as you can see, going back to the third quarter of last year and through the first quarter of 2024. But as you look ahead to the second quarter and even through just over the next year, obviously we are starting to see, in terms of those forecast expectations, we are expecting to see more of a broadening out in terms of the participation profitability that we are seeing beyond tech and communication services. And the reason why this is so significant is because this really supports so many of the calls that we have gotten most recently about arguing about the fact that, hey, even though we're at record highs, close today at another record high for the S&P and the Nasdaq, we still see this momentum continuing, and that is a lot of that really driven by the strong earnings growth that we have seen, but also what we are forecasting to see in terms of that forward earnings growth over the next 12 months. So again, a broadening out here of that earnings growth is really a signal here, a bullish signal to Wall Street.
All right, Shauna. Also, a new step in Apple's relationship with OpenAI. Just learning that the tech giant has secured an observer role on OpenAI's board. This is according to a report from Bloomberg. That seat is going to go to Phil Schiller, Apple's former marketing chief. Schiller is a long-time tested veteran in Cupertino. According to Bloomberg, this job would allow someone to attend board meetings without being able to vote or exercise other director powers, but certainly would potentially give this person a whole lot of insight. Of course, this move also following Apple's announcement at its big software show in June that it was going to offer OpenAI's ChatGPT in its devices, Shauna.
Yeah, and Josh, this really puts Apple on par with Microsoft in terms of that observer role that they're going to have on OpenAI's board. And like you just said, this person does not have voting rights, but again, they gain that valuable insight into OpenAI and how exactly the business is being run right now. And when we talk about the impact, obviously, that OpenAI has had on the AI story has been far from a leader within this space. So again, Apple now having this observer role, a seat on the board, very significant. And you would think potentially that the street could be viewing this as a bullish move here for the tech giant going forward.
Yeah, of course, there was so many questions about Apple's AI strategy and that big software show with announcements like this partnership with Sam Altman and OpenAI. Tim Cook trying to kind of allay some of those concerns and lay out for the street, hey, we do have an AI strategy, we do have AI features. Now, the big question is, does it help create a meaningful upgrade cycle for those new iPhones, which we expect in September? Shauna, thanks so much, and thank you for joining the show today. That's a wrap on today's Asking for a Trend. Remember, in light of tomorrow's holiday shortened trading day, we're going to bring you Market Domination started at 11:30 a.m. Eastern tomorrow. For now, have a great night.